Welcome back, everybody, to another episode of Take Back Control Tuesday. Now, I can't tell you what the outcome is going to be for each and every one of you, but what I can tell you is for the next hour and 40 minutes, the time we're going to spend together, if you apply what you learn, this will change your financial future. If you're here, that means you're ready for change. And tonight, that's exactly what we're gonna deliver. I've got a special guest for you. His name's Jason Sipple. He is a master of what you're gonna learn. But what are you going to learn? Well, Jason's gonna teach you three things. He's gonna teach you how to take back control of your money by being your own bank. And then he's also gonna teach you how to build wealth through your own debts and expenses. That'll be the second thing you learn. And the third thing you'll learn, hence the cars, you're gonna learn how to get all the money back for every single car that you ever buy, drive, and own. And before you get into it, one last favor, just click that button right there, the subscribe button. It would do me a huge favor. And also, right above is a little bell. Smash that bell so that every time I put new content out, you'll be notified. So I don't want to waste any more time. It's time for Jason to really show you all about the infinite banking concepts. Let's roll.
Take back control.
Tuesday night.
Tuesday? What if by changing just one thing, everything would be better for your family financially? Would you make that one change to become financially free? That one paradigm shift, that one new skill is the gap between where you are today and where the wealthiest families stand. Show of hands, who here wants more money? Who here wants more control of their money? And who here wants to be like William Wallace and Braveheart, paint their face blue? Who here wants more freedom? Now that you're awake, I'm going to let you in on a little known fact, a process the wealthiest families, visionaries like the Rockefellers and Walt Disney, have been using a strategy called the infinite banking concept for generations to build and preserve their empires. This strategy is simple, it's legal, and it's available to you right now. It all starts with changing one thing. Start loving yourself more. Start paying yourself first. Just like the little girl who knew that every journey began with care, she gave to her faithful companion first, so it could one day protect her when she needed it most. Shockingly, we're giving away a big chunk of all of our money every time we get paid to the bank, to the government, and to Wall Street. It's leaving our families forever. Right now, every time we get paid, we're making the decision, the conscious decision to give our money to others. Would it be valuable to you to be able to recapture and recycle this money, bring it all back into your family's control? It all starts with one simple change: where your money goes first. So get ready as we dive into the infinite banking process where you take control and keep more money in your family. We'll uncover, how do you turn debts into assets? How do banks make their fortunes, and how you can too, and why success leaves clues. Just like Tony Robbins says, how can you apply those breadcrumbs, those clues left for you? I'll be honest. At first, I thought this was unbelievable, too good to be true. I was working a 7-to-7 job, taking care of my family, and didn't think there was another way. But now, as an entrepreneur, as a builder, I see it clearly. And trust me, once you understand how simple this concept is, you'll realize that financial freedom is within your grasp. We're going to go through those real life examples today, show you real world applications, show you client journeys, and help you shift from being a borrower to a builder. Most of you probably thought that this was unattainable. But here's my only request: keep an open mind, because everything begins with the way we think. So let's get started. The infinite banking concept is an exercise of imagination, reason, logic, and prophecy. So let's start with our imagination. Everyone, unless you're driving, close your eyes and imagine a room where you are on stage and you have 100 new grad high school graduates in the audience, and they are amped up. They have their whole life in front of them. And you ask them a simple question. How many of you are going to be successful by the time you get to passive income or retirement age? They're going to jump up, their hands are going to fly up. They're going to be like, ooh, Jason, call on me. I'm going to be the next billionaire, the next millionaire, the next Steve Jobs, Mark Zuckerberg, the next Elon, the next Trump. I'm going to be the next wildly successful person. They're so excited. But then something happens. Not immediately. It's slow. It's insidious. And it slowly decays that gleam, that hope, that belief they have in themselves. What is it? What is the thing that changes? What is that thing that changes for those excited new grad high school students? What is it that makes this Social Security Administration statistic accurate? How is it that only 5 out of 100 of those students will actually be financially secure by retirement? Not wealthy, secure, meaning they don't have to go back to work. 5. That's crazy. How can it only be 5? We live in the greatest country in the world. That statistic is something that has to be changed. You and me, have to change that statistic because it's just not right. How can we live in the greatest country, the greatest time in the world, and have that be an accurate statistic? It's because we conform. Now, luckily, all of you, you're not conformists, you're builders. You're builders, and you're here to shift that mindset, to empower yourself and teach yourself how to do this, how to make this one change. You are the 5%. You're the ones that are giving your most valuable resource, your time, your attention, your focus in this moment. Let's change this path. Let's change that outcome for everyone, not just those high school students. And this is a quote that I often think about. Everything begins with the way we think, just as our little girl learned. Her vision shaped the journey. When she imagined boldly and delayed her gratification, her companion grew stronger and walked confidently by her side. The problem in America isn't so much what people don't know, as Will Rogers said, it's what people think. They think they know that just ain't so. How profound is that? So who am I and why am I here sharing about your thinking? Why are we reshaping your thinking with Jason Sipple, who's, by the way, in Ocoee, Florida, the city beautiful, if I didn't mention that? Well, we're here because, like many of you, at one point, I was in a mastermind, much like this. And I was there as actually one of the coaches, one of the leaders of the community. And our leader was on stage and he was doing an incredible exercise to help people think long range, to help people think about their big vision. Where do they want to be in 10 years, 20 years, 30 years from now? How do they want their life to look like? Where do they want to live? Who are they surrounded by? What did they need to become during that time to make those changes? How much money were they earning? Millions, billions, maybe hundreds of thousands. It all depends on what your journey, your outcome is. But as he's leading this, as everyone's getting fired up, as everyone is in a state of abundance and possibility, I broke down crying. I broke down and tears just started, this was before I even had glasses, tears started flowing out of my eyes. And I could feel that I was lost. I felt like I had let down my wife, my 2 boys, and I was scared. I was afraid that what I had dedicated myself to wasn't going to solve our financial problems. Yes, I was there leading. Yes, I was there serving. Yes, I was there giving my best. But I realized in that moment that I didn't understand money. What my parents taught me, to show up first, to leave last, to work hard, to be humble, to be polite, was a great advice to be a superb employee and person, peer, but it did not tell me how to be financially free. It did not tell me what the rules of the game were. And without knowing the rules of the game, how could you possibly win? So I asked for help. I asked a close friend of mine, B Reps, for help. I called him up and I'm like, brother, I need your help. I am struggling. I'm lost. I broke down. I had this experience in New Jersey in the back of a mastermind. And man, I know you know your stuff. You've been doing this for 25 years. Help me. Help me secure a financial philosophy. And he reached over to his coffee table and he handed me a book. It's a book that some of you already know about. Some of you have already read. And in a moment, I'll share what that book was. But when I read it, I got angry. Probably not what you thought I was going to say, right? I got angry instantly. I was mad. I couldn't believe that this book existed. I couldn't believe I just learned about it at 46 years old. And I thought to myself, if this was true, every single American would do this. So I read it again the next day to make sure that I didn't miss something. And I called him up and I was like, dude, WTF. We've been boys for a couple of years now. Like we've been traveling together, doing masterminds together. Why didn't you tell me? You know what he said? Pop in the chat if you know the answer. He said, Sip, you weren't ready. Man, I hate it when your friends are right. But he was right. What a profound statement. The teacher does not appear until when? Until the student is ready. So I'm here to share how I've rethought my thinking, how it's possible for you, and how my journey can be an example for your journey. So let's talk about a few of these gentlemen that you might already know about, that already know about this concept. They use it, they talk about it openly, but somehow we miss it because many of them, we've already read some of their books. I already popped up the first guy's name. He has a rich dad, has a poor dad, has a lot of great books out there. This one is actually pretty cool. It's called Second Chance, where he writes about permanent whole life from a mutually owned dividend paying company. And then you got the big guy who I already mentioned, Tony Robbins in Money Master of the Game, section 5.2. He talks about this concept. And then you got the book that I was teasing you guys with, the book that everyone I speak with must read. And I'll even show you how to read it. And by the way, the font is giant. It's only 92 pages, and you don't even need your readers if you need reading glasses. But R. Nelson Nash's Becoming Your Own Banker, game changer, because it shows you not only where our human conditions can hold us back, it also shows you how the game of money actually works and what it means to be in control with guarantees. Anybody here like control and guarantees? I do. And then we have my peers, my partners. We have Chris Naugle, Brent Kessler wrote the modern version for themselves of mapping out the millionaire mystery, where it's their personal journeys. How did they discover this? How did they apply it? And how can you? Great book. And you got Chris, who understands, which I'm going to show you, how do the banks really make money? How do they really make money? And how can we just model the banks? Again, success leaves clues. So let's talk about this intriguing concept. Let's talk about the backwards bicycle. I want to ask you guys, who learns quickly? Who learns quickly? That's right, kids. Our kids learn so quick. And why is that scientifically? It's because they haven't formed those deep neurological pathways from having the same thoughts over and over and over again, where with age, they become ruts. They become ruts like a ski slope that's been skied on over and over and over again. And the older we are, the more difficult it is to change our thinking. But you probably learned how to ride a bike when you were quite young. And do you remember how the bike worked? When you got on the bike, when you took hold of the handlebars, maybe your mom or dad or a sibling were there with you helping you, and you pushed down on the pedal, what happened? The bike lurched forward. When you turned the steering wheel to the right, the bike went right. When you turned the steering wheel to the left, it went left, the handlebars, not steering wheel, to the left. And then you're flying down the street, and then you crash. Skin hands, bruised elbows, bruised knees, and you get up, and you just give up? No, you get back on the bike. Because kids are resilient. They're tough. They get back on the bike. They understand that freedom, that repetition is worth it. So they get back on the bike and they ride and they ride. And eventually they no longer need help. They no longer need training wheels, right? Do you remember that moment for you? Now, what would happen if the bike didn't work like that? What would happen if you turned the handlebars to the right and the bike went left? Well, this welder thought it'd be a fun idea. And that's exactly what he did. And this is a picture of it. If you go to YouTube, we're not going to go through the whole video now, but go to YouTube and watch this. It's amazing. It's fun and it's really entertaining. And it'll show you that when you change just one thing, it can be really hard to relearn that thing that you think you know how to do. Like, show of hands here, who thinks they could ride that backwards bicycle? If you turn the handlebars to right, it'd go left and left would go right, and you go forward and be all wobbly. I always ask everyone here when I talk about this, I cycle all the time and I think I could ride it, but I know that's not the truth. Thinking and being able to do something are two completely different things. I'd fall down. I hope you guys would all wait a moment before you started laughing and say, "Oh, I hope you're okay, Jason." But what if money worked just like that? What if the game that you've been playing your whole life was actually like riding the backwards bicycle? You could do it. It's just going to take a little bit of work. Like I always say, it's going to be simple with simple, but I'm not telling you it's going to be easy. I'm not saying it's going to be easy. So I want you to hold that space, and whatever that I covered today that you get stuck on, because you may get stuck, write a note to yourself and say, "Hey, I just don't know this yet." Whether it's Beatrice or Shane or Patrick, just say, "Hey, I just don't know this yet." So let's jump in. Let's talk about your journey. We're here because of you. This is your hero journey, not mine, not anyone else's. You individually, your family, your outcome, you loving yourself more. So let's talk about the different outcomes for your journey. Where are you going? What is your long-term vision? What is that thing that you dream about? What is your priority? And priority is a singular word. Somehow we've been bamboozled and think that priority is multiple outcomes. No, it's one. What is the biggest outcome that you're looking for? It might be eliminating your debt rapidly. That debt may be weighing around your neck like an anchor. If that's for you, write it in the chat, write I, or write debt. Is debt the thing that is holding you down? Or maybe it's building wealth or building an opportunity fund to make all the purchases in your life. If you're looking for that new car, that vacation, that remodel, put purchase in the chat. Now, the third one is there's only two ways to earn money. It's either human make money or money make money, passive income. This is what R. Nelson Nash talks about with retirement. There's never a retirement. There's a time to use passive income, which means you have absolute time freedom. Who here wants passive income? And then finally, everyone that's here, you guys love someone, somebody, something. Who wants to leave a tax-free estate? Make a note of where you're at in your journey. And everyone's always telling me, "Jason, it's all of these things." Yes, and what's the priority? What's the first step that's going to lead you to your progress, to your big goal? Because remember, like riding a bicycle, the repetition, the function of being a banker and changing the one thing all starts with the first step. So what is your first step? I love it. You guys are sharing there. That's very, very powerful. And so let's talk about why more people aren't successful. Many of you, most of you, make plenty of money during a lifetime. Money has two parts. It has both the math and the mindset. The math and the mindset. So let's look at some of these wealth killers. Taxes. Anyone here, show of hands, don't pay enough taxes? Do you wish you paid more taxes? Think you should pay more taxes? Right? We're 7 days away from tax day. Everyone here got your taxes paid? Inflation. Anyone thinks eggs and gas and everything else should cost more than it does? Market volatility. The market goes up, the market goes down. Everyone says, don't worry about it. You're just in it for the long haul. I don't know about that, but market volatility makes us a little uncomfortable and can be a wealth killer. I talked to someone who lost half of his 401k the other day. 700 to 350,000 in one day. True story. And interest, right? The amount of interest, the volume of interest, because why? Again, we're thinking on a monthly basis, not long term. Now let's look at the mindset. It's like I told you with the 118-year-olds, right? Following the status quo. I have a fun saying for this. This is being a sheeple. Just following along, going along with the flow, following the sheeple. Fear. Two fears in life: fear of failure, fear of rejection, right? Fear of failure, fear of rejection. And you can't fail until you're no longer here. There is no failure. There's one judge. Guess what? You can't fail. You can only learn. Blessing or a lesson. Life distractions. We're all busy. I get it. I work with a lot of really successful folks like you guys. We're all busy. But if you knew that by changing one thing, everything would change, and it would take maybe a few hours of your time to start learning this and start deciding how you can implement, would you make that change, or would you keep being distracted with kids, running businesses, jobs, your health, your family? Life is always going to present new challenges. That is why life is fun. Otherwise, we'd all be robots, right? Same robots here. And then what we're taught. Who'd you learn about money from? Where was money taught to you? Was it in school? Was it by your parents, your grandparents, an aunt, an uncle, a friend, a peer, a coworker? When I think about this question, I think all the time, I don't think I really ever learned about money. No one really ever told me. I knew how to rake leaves, mow lawns, trade my time for money. And I thought, oh, this is cool. I'll just do things that I kind of like, that I can do, and someone will pay me. And then the rest of the time is my free time. But I never really thought about money and how does money actually work. So we're going to dive into that next. So let's start by talking about some fundamental questions about money. First, we're going to start off with an easy one, right? The mysteries of money. What is your definition of money? Pop it in the chat. What is your definition of money, right? Money to me is nothing more than a means of exchange. We're going to pay money for home, home for money, money for food, food for money, money for phone, phone for money. So money is nothing more than a currency. That's right, a means, a tool. What company uses compound interest? Don't get too excited. Ooh, call me, Jason, I know it. You might have said banks in your head or in the chat, but banks don't pay compound interest. They might give you interest, but think about this. When you go in and you go to the teller and you're all proud of yourself and you bring your paycheck and you deposit all those fresh $100 bills, they don't take your name and write, hey, Beatrice, Paula on the bill and then stick it in your safety deposit box, do they? No, money has to stay in motion. Money doesn't sit there and compound. Money has to be in motion. Like everything in nature, it's a natural law. You don't drink water from a stale pond or catch fish from a stale pond. You need things to be in motion. The blood in our body has to be in motion. That's why exercise is so good. Motion. It's a law. Money must stay in motion. And then are your dollars worth more today or in the future? If you get confused by this, I always think about candy bars. I know we're not supposed to eat them, but man, if you had to pick, what's your favorite candy bar? Mine's either a Snickers or a Mounds, kind of depends on the day. But think about it. If I go back to when I was younger and I had $1, I could buy a few candy bars. Today, I don't even think I can buy a candy bar with $1, right? So your money's always worth the most today. Today's the most valuable your money will ever be. It's just like today's the youngest you'll ever be for the rest of your life. So if that blew your mind, I apologize. Taxes, they going up or down in the future? Up or down? I don't know. I actually don't have a crystal ball, not a financial advisor, not Nostradamus. But if I had to take a guess, either taxes are going to go up in the future since they're historically low right now, which sounds kind of crazy, or more things will be taxed because our government doesn't make money, doesn't produce money the way we do. The government makes money by taxing us on more things. Sham says, always up. This last one, what do you know about your retirement? How many folks here are putting money into a qualified plan, putting money away into a backdoor Roth, into something that's tied to the market? I get a bunch of eyes or people that are participating. We got Pete. Excellent. So I'm going to tell you a story, Pete. This one's for you. I'm just picking you because I saw your name pop up with me first. I got a nice Uncle Sam there. He looks friendly, right? Everyone that has their money in a qualified plan has a silent partner. Now, this silent partner, he is phenomenal. He is so kind that he's not checking in on you. He's not seeing if you're maxing out your contribution, maxing up to your max, or he's not checking at all. In fact, he's pretty absent, but that's okay. You're taking this little tiny seed and you're growing it into this great big harvest. And as you're doing this, every year you're meeting with someone and they're telling you how long the money's going to last, how long you might be able to, be able to survive off of the money that you've been putting away and paying your future self and doing all that hard work to earn that money. And your partner, he's out having a blast. He's traveling the world. He is seeing the sights. He might be even at the bar somewhere. It's always 5 o'clock somewhere, right? And then when it comes to your passive income time and you go to take the required distribution, your partner comes back in. He's like, Pete, man, Pete Marshall, you rocked it, brother. And he hiccups. You were incredible. You turned that $1,000 into millions. And guess what? I'm going to need my 38.5%. Thank you very much. I had a party. You worked hard, but I'm going to need the money now. That is the contract we're all in with a qualified plan. Now, I'm not saying stop immediately, but I'm saying think. I'm challenging your thinking. Now, everything I just shared, it might be a lot. One thing might have been a lot, but I want you to start thinking. Again, I'm not telling you what to do. I'm telling you, is your thinking on point? Is your thinking the most optimal can be to help you reach your goal? Remember, a couple of slides back, we established what was your goal? What was your vision? Where are you going? Your destination. So let's jump into this. Let's talk about the money multiplier method. Let's talk about mapping out the millionaire mystery. Let's talk to you about how this life-changing method is so simple. It's stupid simple. It's only 3 parts. The first part is the machine. And I've already talked about the machine. I've already told you it's infinite banking, and I'm going to show you exactly what the machine is and how it works as we go through this. So you guys don't have to think about it. I will show you. I will teach you. Next is going to be the marathon. Now, if you guys know me, saw earlier on my slide, I don't love running, but if I'm going to run, I'm going to swim 2.4 miles and ride my bike at least 112 miles before I do a marathon. Now, I'm retired currently, but one day, my youngest knows this already, but I'm going to groom him to race with me because I think it'd be super cool. And if I can get my oldest to do it with me too, he's listening right now. And so I can imagine his face, but I would love to have my boys do an Ironman with me one day. And then finally, you have, because remember, it's not get rich quick. That's why. So I went off in nostalgia for a second, thinking about Ironman, thinking about competing. If you guys ever get a chance to, you'll learn more about yourself during that training than anything else I can think of I've done in my life. And finally, we've got the millionaire mystery. I'm not saying you all want to be millionaires, but if that's a goal, I'll show you factually how to optimize your money by changing one thing to reach that outcome. Maybe you want to be a multimillionaire. Maybe you want to be a billionaire. Whatever your dreams are, they're your dreams. Maybe you want to be someone who has a few $100,000 and is just comfortable. Whatever your goal is your goal. Don't let anyone tell you need more or less or anything. It's yours. Okay. So let's jump into this. Let's talk about the machine. The machine we're going to use is nothing more than a dividend paying whole life insurance policy from a mutually owned dividend paying company. Again, it's especially engineered for you, cash rich, whole life policy from a mutually owned dividend paying company that's been profitable for at least 100 plus years consecutively. Remember, the partnership is going both ways. You want to be an owner in one of these companies. You want to be an owner in one of these mutually owned companies like I am and my peers are in the different companies that we work with. And then the ones that own the machine, the mutually owned dividend paying whole life company, want a good partner in you. They want a good partner in you. It is a everyone thrives scenario. What it is not, this is so important because I'm hearing this all the time. We are not talking about the following. ULs. That means universal life. That means tied to a market, to a fund. We're not talking about IULs, index universal life, VUL, variable universal life, UL. And someone who's kind of paying attention is thinking, oh, wait, Jason's talking about IULs. Cool. I want to learn about those. No, Jason is not. He's not talking about those. He's saying they do not work for the infinite banking concept because they take the control away from you and hand it to someone else. They take the control that you have in the unilateral contract with our machine and hand it to the insurance company or hand it to the agent where it is controlled out of your hands. Okay. There's no control or guarantees. And term has a place. It's not going to be used for banking anyhow, but we're not talking about any of those things. Like Beatrice said, it is epic. Now let's do a quick interactive chart with you guys. So draw across, grab your pens, grab your pencils, grab a crayon, draw yourself a T. In the top left, you're going to write bank. In the top right, you're going to write policy. The bank, the policy. We're doing a Coke versus Pepsi taste test, or maybe a Coke versus Coke. Which is the best Coke? You know, you see all the commercials. That's what we're doing. And we're doing this because I want to show you if you're changing the one thing, where are you keeping it? Where are you keeping the one thing that we're changing, the money? So under bank, liquidity. Under policy, liquidity. Someone in the chat define liquidity. What is your meaning, or what does liquid mean to you? To me, it's like water. It's accessible. It's not locked up in a financial prison. It's not over there where I can't get it. I can use it for the things that I'm going to want to need and buy and invest in my life. Under bank, anyone that has a high yield savings account, please post how much you're getting paid currently. I know it's been slowly dropping, but most of the time when I'm teaching this, I get 3.8, 3.5, 4.1, 4.2. It was higher earlier this year, but lately it's been coming down. So if anyone has a high yield savings, pop it in the chat. What is your high yield giving you? That's going to be 0.07% if it's in just a regular old savings account. 3.5 from Sham. That's awesome. Perfect. That's what I needed. So write 3.5 on the bank side, Sham. On the right side, write 3.25% and do a little G1. You know, that's your G1. That's guarantee number one. 3.25% is contractually guaranteed. Can't ever do worse than that. It's a guarantee. You guys like guarantees? Under bank, you have taxable. The 3.5% that Sham shared with me is all taxable. That growth is taxable. Under policy, it's tax-free. Tax-free growth, tax-free loans, tax-free distribution. It's called tax advantage to be appropriate, you know, being a certified IBC practitioner and all, but tax-free. You're paying taxes today. You're not paying taxes in the future. Uncle Sam is out of your life. He's not coming back and coming in and popping an elbow into be like, psst, partner. Nope. Under bank, you have unstable or not stable. I'm not someone that teaches grammar, so I'm okay with either. I think unstable is the correct way. Write whatever feels good for you. And Jason, define unstable. What do you mean? Well, first, I mean, it's a fractional banking system, but what does that mean? Well, let's look at what happened first, or what happens with fractional banking. Think back to the Silicon Valley Bank in the beginning of 2023. $204 billion failure. Within a month, Signature Bank, $100 billion. Remember the bailouts, all of the controversy in the news? If you go back to 2008, 2009, the Great Recession, you're talking about 364 banks failed. Guess how many large mutually owned dividend paying whole life companies failed? That's right. 0, goose egg, zilch. Why? Because fractional banking means exactly what it sounds like. It's a fraction. They keep a fraction of the money you put there, and somehow they turn the $100 you put in into 1,000 by lending it out, which you're going to see in the upcoming slides. Under policy, you have stability. Why is it stable? Well, one, they're betting on one thing: how long I'm living, how long Sham's living, how long Paula's living, right? They know, they have actuarial scientists that know within a month of how long we're going to live. So the only thing they're betting on is how long will we pay our premium deposits. That's a pretty good partnership. They take on all the risk, they give us all the guarantees, and their stability is because they have been betting on one thing for 200 years. And guess what? We haven't changed that much. If anything, we're living longer. So they're even more stable, more profitable year over year. Underbanked, unprotected. Any entrepreneurs here? Right? If you're an entrepreneur, someone gets hurt on your property, someone gets hurt or sues you, right? Judgment and liens. If your money can be taken from you, is it really yours? Think about that. If the money can be taken from you, is it really yours? Well, in a bank, it's unprotected. Well, under a policy, it's protected against judgment and liens. Now, if you live in the great country of Florida, like myself, it's fully protected. States vary from state to state, but 37 states are fully protected. And no matter what state, it's more protected than in a bank. So far, we've talked about the living benefits, the guaranteed growth, the tax-free growth in a stable environment that's protected from the law that you have access to. It's not locked up in financial prison. And then under the bank, you have no cherry on top, right? There's no cherry on top. Whatever money that all of my folks, Donna, Sham, Paula, have in their high yields, well, if they use that money's not doing anything else. It's not protecting their family. It's not providing anything else in terms of legacy, right? There's no death benefit. Well, under policy, this is G2. So we got G1 at 3.25% and G2, the last line of a tax-free estate. The best thing we could pass on to our families, to the things that we love, to the people we love, to the causes we love, is a tax-free legacy, a probate-free legacy. So now all of us, everyone here, we're now going in and we're on the board of directors at our bank. And they ask us, so we just created this chart together, and we, the bank, needs a place to store our stable money, our money that has to be guaranteed, our money that has to be accessible. Where are we putting it? Are we putting it on the left side with the bank or the right side with the policy? And if you said the right side, duh, like Jason, it's obvious. Well, of course. This is why the banks have 4x'd, 4 times the amount of whole life, permanently owned whole life that's specially engineered with cash value from a dividend paying whole life company in the last 13 years. They have quadrupled that number. This is why banks have $225 billion of specially engineered whole life. Is that a lot? 225 billion? That's a lot of dimp.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up.
So now we know where the banks are storing their money. Just ask yourself, where should you be storing all of your money that you need access to, that you want it to be protected? This one I'm going to go a little faster. We're going to use Sham's example of 3.5%. So Sham, you have been saving for your new car. Whether you're buying a Ferrari or a Fiat, just add a 0 if you need a different kind of car. But you're coming to the Bank of Sipple, the bank adjacent, and you've been coming for years. You have a lot of discipline. I really appreciate the discipline you have. And you've been storing your money at the bank. You didn't know about what I just taught, so you weren't storing it in a policy. You're putting it in the bank. And the bank is paying you 4% because I'm super generous. I knew you were getting 3.5, but I wanted your money, which you're going to see why here in a few minutes. And so you give me your money. And I say, when you come to get the money out, to take the withdrawal, I say, oh, whoa, Sham, come here, pal. Let's talk about this. Let's talk about this. What if I give you a loan for $25,000 at 6% for 5 years or 60 months? I will keep the money right where it is. You don't have to work any harder, do anything different, but I'll keep the money where it's at in our bank, in my bank, for the same amount of time, and it'll keep growing at 4%. And here's the crazy thing. It's going to grow at 4%. You're going to take a loan at 6%, but at the end of 5 years, you're going to have made money. Do you trust me, Sham? Am I telling you the truth? Is this actually going to happen? You know, can I have the money growing at 4 and borrow at 6 and make money? Sham says no. Well, let's play it out. Let's let the math tell us. So if you made your monthly payment of $483.32, the future value, let's get a future value calculator, $28,999. By the way, this blew my mind too, so don't get stuck here with me. Just watch what happens. The future value of this money growing uninterrupted compounding for those 5 years is $30,000. Now, I don't know where all of you are at, but in Florida, at least where I'm at, 30,000, maybe not in Miami, I'm not sure, but 30,000 is definitely more than 28,000. So Sham, you did in fact make money having your money grow at 4 and borrowing at 6. Why is that? Well, the money's compounding uninterrupted and compounding, right? Interest that's earning at 4, and you're paying down a loan on a depreciating scale. So as that loan gets smaller, you're only paying that much money. So you made 1,526. Imagine if you added a zero. Now you made 15,260. And you can actually do this for almost an inverse scenario. You can do earn at 3, borrow at 6, earn at 4, borrow at 8, and have it still be profitable. So let's not get stuck on the percentages. Let's look at the actual cash flow and what our money's doing. This is, again, we're challenging the thinking. Make sense? So now we're gonna have Sham, now that I've already helped you make money, even though you didn't think I was telling you the truth, but over 5 years, you come to trust me more. So now you're gonna put all 100,000 bucks that you have that you want to store into my bank again. I'm still gonna pay you 4%. But remember earlier when I said, hey, money has to be in motion to make more money, right? So let's look how the banks use our money. They have to keep it in motion, because when your money is deposited, is that an asset or a liability to the bank? Is it an asset or a liability? You're right. You're right. It is a liability. You might have said asset, but it is a liability. So the banks have to do what? They have to keep the money in motion. So the money comes in, the banks instantly lend it out to someone who's buying a home. The money comes back right to the seller, and it goes out to the car, and then the money comes back from the dealer, and the money goes out for a home remodel, and the money comes in, and now it goes back out again, right? So you have the money constantly going out and coming back in. Remember, every time someone pays for something, the money has to be stored somewhere, so it goes back to the bank. And the bank understands they got to move the money out. That's what fractional lending is. So they move it out again. So let's look, how much does the bank just earn off of the 100,000 that Sham deposited, right? So the first scenario is 7 minus 4. They've earned 3%. It's about the spread. That's what we're talking about here. Now the next one, 8 minus 4 is 4, right? You need that blue Beamer to go with that blue home. Now 9 minus 4 is 5. Pretty easy math so far. Nothing complicated, right? 12 minus 4 is 8. So now you got 7 plus 12, right? 7 plus 13. Wow, Jason's math is not good today. Now, if we add all these together, we get 20. How much larger is 20% than 4? Is it 16% larger, or is it 5 times? And think, how much risk did the bank take on in all these scenarios? With the home, they're in first lien. Is the bank own your home until it's paid for? Yes. The car, same thing. The home remodel, your home again is the lien. Where they have more risk is the debt consolidation, but they just charge us more interest. So the bank is taking very little risk. They're taking your hard-earned money, and they're earning 500 times more than they're giving us, even in a high yield account. 5 times, so 500%. Look this up on BauerFinancial.com. The banks make annually between 400 and 1,300% on our money. Between 400 and 1,300%. Is that not insane? Do you want to know how you can control this function? Remember, it's not a get rich quick, it's a marathon. But you guys can apply the same principle with what we're teaching. Now, this one, who here wants a 35% raise? I know I just keep asking you questions that are too good to be true. Who wants a 35% raise? Anybody? I do. I'm going to put my hands up. I do. Paula says me. All right, so let's look how, this is how the average American has been spending money for the last 5 decades. Okay, for at least the last 50 years. We spend about 20 cents of every dollar on our automobiles. Then 30 cents of every dollar on our homes. And if you bought a home in the last couple of years, please don't look at your mortgage statement. I'll tell you why in a minute. And then 40 cents of everything goes to everything else. So now we've got 90 cents of every dollar. We're being super generous and saying that we're saving 10%. Now, you and I know if you looked up our savings rate, like since 1985, it hasn't, other than the pandemic, it has not been 10 cents. It's at like 3.5 or 4 cents we are saving, paying ourselves first. Remember, like the little girl told us in the companion, all we have to do is love ourselves a little bit more. And I want to keep bringing that back, that point. But we're going to assume this person, Sham, we're going to use Sham again, is saving 10%, which is awesome. So now let's look. Let's look how much is interest. Remember I said I'm going to give you a 35% raise, or at least show you how by helping you think you're thinking. You got 5 cents of every dollar is part of the financing, right? Remember, we finance everything we buy. We pay interest, earn interest, or give up the opportunity to earn interest when we pay cash. Now for our home, wait till you see this number. It's a little bit sickening, but you got 25 cents of every 30 is going towards interest. First 7 years of your mortgage, you got 70 to 80% going towards the interest only, not towards the principal. And then everything else is 5 cents. So right there is your 35 cents. 5 for the automobile, 25 for the house, 5 for everything else. And we have shifted and made that 10 cents into 45 cents. Anyone want to be paying themselves 45 cents of every dollar they earn? Remember, the first rule in being wealthy is pay yourself at least 10%. That's from the richest man in Babylon. I've talked to someone, if you guys didn't think it can be done, I talked to someone making about 100,000 a year and paying himself 50% of what he earned every month. And he was the only earner in the family. His wife stayed at home with their kids, their 3 kids, and he's able to pay himself 50%. Now it's just a matter of where is he storing that, right? So it is possible. But this over time is how you tilt that seesaw back in your favor. Like right now, remember that gorilla around your neck. If you have debt, if you put debt as your outcome here, what you're trying to solve for, it's really about just changing that one thing. How can over time, by paying yourself first, can you take back charge of that debt and pay that interest back into your family? So now, who here wants to know how to finance things in an alternate way? How to get back all the interest for all the cars that you're ever going to own the rest of your life. A better way to purchase. Just who wants to know about this? Ooh, Donna says me. Shane likes the 45%. I do too, Shane. I recaptured $3,300 a month that used to go out to 10 other families, with the SoFi family, the Ford family, the Hyundai family. You guys know the families. Citibank, Bank of America, Wells Fargo. We've all given money to the same families. Why not bring the money back to the you and me level? So let's look under the hood, the machine. Most people think of premiums when they think of car insurance, medical insurance as a payment. But when we're talking about building our banks, we're going to talk about the premium is a deposit. Remember, it's our language. Our words make our world. So our premiums are our deposits, premium deposits. We're not worried about the age of the individual. We're not worried about the death benefit. And again, we're going to agree that we're going to use the language premium deposits. So let's look under the hood and talk about how we can buy that $25,000 car. So we're going to change the one thing. Now, this individual, we're going to pretend they're making 100 grand a year. So paying themselves 10%, they're now saving $10,000 a year. And where are they storing it? I showed you on the T chart. Where are we storing our money? We're going to store it in a policy that's specially engineered for us, where we can save our money, spend someone else's money, and protect our family. So now deposits are made in years 1, year 2, year 3. And after year 3, we're ready for that new car. We're ready for that new car smell that Sham can't wait. I don't know what color Sham's car is. I'm going to guess it's red. I'm guessing it's red or white. It's got a leather tan interior. It's a nice smelling car. Leather smells great when it's new, doesn't it? Gets the car and starts paying back, because Sham's an honest banker. Not going to steal from their bank. We're not going to steal from our banks. We've started a new business. That's what I'm teaching you. And we're going to pay ourselves back. Instead of the 483 and change, we're going to make it 500 a month, 6,000 a year. So now we paid that back monthly into the loan we took. And now another 5 years goes by. We've put a total of 70,000 in 7 years into the policy as premium deposits, just where we're putting our savings. We've paid the car loan back to ourselves, $30,000. Remember, we took a $25,000 loan for a grand total of $75,000. But look, something interesting happened. Our cash value was never interrupted. It kept growing. And we actually have 91 cents of every dollar because why? The interest that we used to pay out to the other companies now came back to Sham's family. Isn't that wild? Now we're going to do something even crazier, something I'll never teach any of you. If I am your mentor and teaching you how to become a bank, I will never show it to you like this, but let's look what happens. Now in policy years 8, 9, 10, 11, and 12, we've made no deposits. You can typically do that after year 7. Now you got the car purchase at $25,000. Again, right? Another newer model, more advanced model, better smelling model. But we're going to be an honest bank again. That's the only thing we're going to do the same. We're going to pay that $30,000 back in, minus the $25,000. So we've really contributed $5,000, above and beyond what the loan was. But look, our cash value has grown to $23,592. That's pretty amazing. And just think, every year as your policy gets more efficient and the compounding becomes greater because of the amount of premium deposits you've made, that number is going to keep getting bigger and bigger and bigger. Who thinks that this might be a superior way of buying a vehicle? And if this works for a vehicle, what else can this work for, right? We got the 3 rules. 1, remember we're talking about loving ourselves. Pay yourself first. Pay yourself first as if your life depended on it. You've been trained your whole life to give up control of your money, to pay all your bills first, and then put what you have left into savings. What if you just made that change? It's that easy. Just pick a date, start. Number 2, pay yourself with interest. And I love what Paul and Beatrice are sharing. Yes, watch this over and over again. Watch it with the frame of thinking long-term and paying ourselves first. We're not saying, hey, you need a specially engineered whole life policy. That is the vehicle. That is the machine. What I'm saying is learn the new skill set of being the banker. Understand how this works. Read this book. When we have a call, if you haven't read this yet, I will send you the step-by-step on how to read this. So paying yourself with interest, being the honest banker, and finally recycle and recapture your money, meaning that all of the things you're going to finance, you're doing through your banking system, not someone else's, and you keep paying your premium deposits to build that opportunity fund over time. I've already said this, if it works for a car or a truck, what else can this work for? So now let's talk about your debts. Let me show you. Now, this is not yours because I didn't connect with you yet, but some of you here have already done this with. But let's talk about one of our clients. One of the things I said earlier about our thinking is first, we have to know the rules of the game, and then we have to play better than anyone else. Well, Albert Einstein taught me that, and I love that because that is exactly what happened when I asked my mentor, Brian, my original mentor, Brian, for help, and he handed me Nelson Nash's book. And over time, it didn't happen overnight, but over time, over the next 2 or 3 years, we recaptured all of our debts, much like this chiropractor from Minnesota is about to do. And let me show you. He came, he saw this presentation. He saw Brent Kessler do this presentation, and Brent was a chiropractor. If you guys didn't know that, he almost had $1 million in debt that he paid off in 39 months. Well, this is a unique situation. Remember, this is always specially engineered for you. So this chiropractor, he's, I think, 40, 45 years old, comes up to Chris Naugle after the talk and says, hey, that's really cool. Can you guys help me? And Chris said, I don't know. How much are you paying yourself? How much are you saving? He says, oh, well, I'm putting like $25,000 into a qualified plan every year. Does that count? And Chris says, sure, it does. Are you willing to maybe move where that money's going first before it goes into anything related to the market? And the chiropractor's answer was, well, yeah, if you can show me mathematically how it's going to help me pay off this $5,777 a month that's leaving my family in less than 19 years. If you can show me that, I will follow the steps. I will make the progress, because progress is what? Progress is happiness. So he agreed to start a $25,000 a year policy. And in year 1, right away, within the first 30 days, right, if you believe like I do, the wealthy have more choices. Is that fair? So makes a $25,000 deposit, 14,800 and change is available. What are we going to do with that money? Well, we're going to pay off Discover, we're going to pay off Lowe's, and we're going to point that money that used to go to the other families. People get confused here, and we're going to point it back to us. We're going to complete that circle. So it's been leaving us. Now we're standing over here too, and it comes back to us, right? Complete the circle. So that $448 a month, almost $6,000 a year is coming back to us. Next year, same deposit. Look, the cash value goes up, the payments back to ourselves, add them together. What are we going to do next? We're just going to do the same thing. So now we're only 2 years in, and we've recaptured almost $2,000 a month. Has this chiropractor worked any harder, any longer, or had to do anything different? Right? No. All they're doing is changing one thing. Where is their money going first? Year 3, $25,000 deposit. He already hits the efficiency point, which I usually see year 3, year 4, year 5, just depending on your age and what we're designing and who we go with. But let's say he's got the extra $541. He's paid himself back $23,000, which is a 1917 times 12. He's got 48 grand. What do you do with it? Well, of course, because he's got a condo, he's got to have that blue Beamer and a boat. So now we're going to pay off the blue Beamer and the boat. We're going to recapture that money. Now he's almost got $4,000 a month coming back to his family. That's that 35% raise we were talking about already, and we're only in year 3. So let's talk about the marathon. How much do we put in so far? 25 grand each year, right? And all we did is move where it was going. It's no longer going to the government, to qualified money, to our partner. It's going to our system. The loans, 14K the first year, 16K and change, 25K and change, 55,000. How much is left in the policy of the cash value that is still compounding and earning us interest? Is it the $20,000 difference? What do you guys think? Yes or no? No, it's all the cash value is still growing and earning us compound interest and most likely earning a dividend. Year 4 makes another deposit. The cash value grows by more. Right now he's depositing $1 and getting $1 and change back. Payments back to himself, 3,677 times 12 is 44 grand and change. Remember, if you're getting lost in the math, just remember it's our thinking. All we're doing is changing one thing. We're paying ourselves first. We're taking a loan. We're paying off things, and we're redirecting the money back to us. That's what's happening here. So now we've knocked down the condo. Weren't able to pay it off in its entirety. We get to year 5. Cash value goes up again. Now we've paid off the condo, recaptured that $879 a month, and we have that money pointing back at us. So we get to year 6. Now, something interesting is going to happen in year 6. One of the things that we have to be careful with in these policies is that we can only put in a certain amount of money before we get to the point where we can't stuff anything else into it. It's like I always ask people on my calls, it's a 12-ounce coffee mug. It does say, I am a legend of a dad, a myth of a dad. But we get to the point where we can't put more than 12 ounces in. What do we have to do? We have to open a new warehouse of wealth. So that happens to this doc in year 6. So now he's only going to deposit $10,000 into his existing policy, right? His policy at 6 years old. It gives him cash value of 13 grand. And now he gets to a point where he's like, I'm going to open that second policy because I have all this extra money and I want it working for us. I want us protecting my family. So now he's got the second policy, the first policy, and the payments back. He's got $6,000 extra dollars in year 6. So he pays off the condo, throws a big dinner with that 6 grand, celebrates, gives high fives, and that's how long it takes. Wouldn't you guys like to know, and gals like to know, how long does it take for you to pay off your debt? Would that be a valuable tool? Would you want to know as you're going through underwriting to get approved by one of these mutually owned dividend paying companies that you could actually know exactly how long it would take to pay off all your debt, how much interest you would save from paying the other banks, the other families, and how long it would take to pay yourself back? Well, that's what we'll show you. We'll show you that, and it's complimentary. Again, sounds too good to be true, but our goal is for you to be able to connect the dots and change that one thing. And why do we do it? Why do we help you guys? And we're paid from the smaller part of what we designed for you guys. And we do it because 91% of the people that we help, of the 3,000 people I've had conversations with, The ones that start, 91%, will start a second policy, a third policy, and on. They'll start more warehouses of wealth within the first year once they see that it's actually not too good to be true. So I've said this once already, to progress equals your happiness. I want you to pause this, pause your thoughts, pause your thinking, and just celebrate for a second. You've made it this far. You've learned that you only have to change one thing, and you should give yourself a little bit of a high five, a yes, I can. I'm going to ask you a fun question. How do you eat an elephant? Like my wife Patty says, you don't start at the ears, Jason. You got to start at the feet, and you take it, what? One bite at a time. One bite at a time. And you're going to have a plan, a vision of you're going to eat elephant for a long time. That's a big animal. You're going to have elephant steaks, elephant stew, elephant kebabs, elephant. Think of everything that you can have, burgers. And the man or the woman at the top of the mountain didn't fall there, did they? They had to take it step by step. Remember, meet yourself where you're at in the journey. Your journey, not mine. I'm here to simply support you as your mindset money mentor. So, and by the way, no elephants were hurt during this filming, during any filming ever, and talking about how you can map out the millionaire mystery. Is it possible to owe no man or no woman nothing? Yes. This machine works for everything. We're only limited by our imagination. So if we continued, like I said, it's going to get better. I promise to map out the millionaire mystery. Let's wrap this up with a pretty little bow. We're going to pay back the homes as promised. Condos 879 times 251 months. House 1221 times 224. Add those two numbers together, you've got almost $500,000. But wait, it gets better. Don't forget, it was earning interest, all that money. So now you've got $750,000, $750,000 right there by just doing what you're already doing and bringing it back to your family. Is that not exciting? So now that you know this, shouldn't everyone do this? If you're not doing this, aren't you physically stealing from your kids, your grandkids' kids? Like you're stealing from your family members for those that you love. I know you guys don't want to do that. You're here because you want to create that legacy. You want to interrupt the patterns that we've had in our families. And like our friend Warren says, whoa, that went fast. If the poor people would just do what rich people do, they wouldn't be poor anymore, right? They wouldn't be poor anymore. So I don't want to shock you guys too much. There's only one of two things that's going to happen here. We live. Are we better off with or without this? Or we die. Again, are we better with or without this? Just answer it in your head or put it in your notebook. So now that we're at the end, you have a powerful opportunity for yourself, a powerful question to ask yourself. And, when we look at this at the end of this journey, and it's the beginning of your journey if you haven't started your process yet. But like the child who returns to find her companion too weak in the end, she can't go on any more grand adventure. She hasn't delayed gratification. I look at that as many of us because we've been groomed to give up control of our money. We haven't been a good companion to ourselves. And it's okay. We have to be honest to have progress. So now you have a choice to nurture your system today or risk having nothing yet left to shield you when the dragon comes. And I hope that you all get what you want from this training. I hope that you came here, you found value. You've given me your greatest asset, your attention. And with your attention, I hope that this served you. Like the little girl and her companion, this is a journey about love. It's about paying yourself first. And you have a choice. You can either keep watching or you can take action, book a call with me. If you're someone that's already saving, you have discipline, you're making more than you spend, or maybe you have financial leakage and you just need someone to guide you. Book a call with me and I will give you an hour of time to meet you where you're at and to help you either start your journey to become a mutual owner in a dividend paying whole life company, or I'll give you the next steps to get to that point. So I appreciate each and every one of you. Thank you again. Be blessed for your time. Have a great rest of your week. Take care, y'all. Have a good one.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.